So if you think of what happened in the equity flash crash in 2014, we saw something very similar, right? Big multi-billion dollar companies down 80% in a minute, 3 minutes. A lot of those trades got cancelled by the exchange because there's regulatory bodies, there's all sorts of, in crypto, we don't have that. So what happened was the liquidation cascade starts, there's forced deleveraging, but then the Binance API went down for the market makers. That couldn't have been a worst possible outcome. Now, let's assume it just happened because everything was breaking at the time. No market maker was able to bid in these liquidation cascades. So they became much more exacerbated. So who then bought, because we couldn't as retail get onto the platforms either. We were pretty much shut out of everything. There was this whole discrepancy between Coinbase and Binance. So who stepped in to provide the liquidity? Sure, the market makers came back. They got some, but we know they got slightly impaired because everything shut down. They couldn't trade. And my guess is the exchanges, because it happened on a few Asian exchanges as well, probably had to use their balance sheet to step in to provide liquidity. Because if they hadn't, it would have broken everything. Everything would have kind of gone to zero. So it would make sense to me that that occurred. And nothing nefarious. It's like, what the fuck do? We need to do something about this. We need to provide liquidity. So you use your balance sheet and you buy whatever's being liquidated. So then you've bought a whole bunch of altcoins, Bitcoin, everything. I don't know how much, let's say the number's 10 billion. Who the hell knows, right? Now you need to get rid of that off your inventory because you can't hold it on your balance sheet. They're not a hedge fund. So then you've got to work it out. So how do you work it out? Well, you kind of do it like you did in program trading and equities, is you work it over time, which would explain why we got these weird, as soon as the US opened, 10 o'clock, the most liquid time of all of crypto, the slam. Because somebody uses an algorithm, what's the most liquidity? That's that time of day. How much do we need to get out of? Let's say it's, X, 200 million a day, whatever the number is, and you get the slam. And that had the footprint of that. We didn't see any other evidence on chain of others doing stuff. So it kind of made sense to me. And I think that created the liquidity gap the other markets didn't show.
Yeah, it sounds like the most reasonable theory. I mean, especially if you look at how prices have reacted since, and they just struggle to catch any sorts of bids. And the moment you get any sort of rally, you always get these sell-offs. So
we've also got the other issue is there's a huge amount of call selling by long-term holders. And all of these Bitcoin yield products, they're all based on call selling, really. There's some lending, some call selling. MicroStrategies cause a lot of call selling. So you've got that natural dampening of the market of people kind of extracting a bit of yield out of their long-term holdings. I think most of us would assume that is around the 100,000 strike, that people have been doing that. And we kind of need to clear that out of the way so there's less delta hedging when it happens. By the end of Feb, we should be significantly higher.
Is that based on because you think that there isn't a certain amount of inventory that once it's cleared, that's
no,
it?
Because the forward-looking elements of liquidity are accelerating. And so therefore price should follow liquidity.
I get it in terms of the demand side of it. Yeah, but I'm just curious in terms of this supply side that just seems to need to dump because they've got the stuff on their books. Like, do you have any sense of that, much longer this can go on for? I mean, how bad is it really? How big are the bodies and how many market makers were impaired?
We haven't. I'm looking at, like the hourly chart because you can see it. We've only had one or two of these this year, but we were having it every single day before. So I think it's gone. I think it's gone for now. But people are still licking their wounds. There's less capital in the market. And, gold and silver had a big run. Tech stocks have had a big run. So speculative capital moves for the place with the fastest rate of return. And so speculative capital hasn't come back in here yet. And that kind of makes sense to me. It just takes a while to repair. I looked at the bear market lows in 2022 after that final leg down. Again, remarkably similar to now. It takes a digestion period, and that digestion period's not a few days. It's basically, a couple of months or longer. And I think we're just doing that.
What do you think this means for the future in terms of offshore exchanges? Do you think it shows the need for some sort of a regulation? How do you think the industry is going to change going forward? Because I'm sure you've seen a lot of, there is a lot of hate in the timeline and there's a lot of concerns about this and people pointing fingers. Like, how do you think the industry evolves from this event?
I don't think anybody wanted that event. On crypto Twitter, everybody wants to go to some nefarious actors. I would put it the other way around. They probably didn't want this to happen. And they had to do something, if indeed that is what happened. Regulation, well, we're still waiting for the Stability Act, the market structure. We still don't have this in place. So we're still a bit in the Wild West. And, all global exchanges, if they want to operate within the United States or in Europe, will end up with having some forms of regulations. So I think over time they get more regulated, and that's fine. But there will also be these small ones that are unregulated. Crypto is still the Wild West. It's a decentralized, financial market of which, who knows what can happen.
I think it further shows the need for like the rise of perp dexes and decentralized exchanges.
Yes, but they can still have issues where things go wrong, right? You can have just because you think it's all run by a smart contract doesn't mean things can't go wrong.
I guess this question, I suppose if it's open source,
hacked.
people could have spotted
the other thing that happens to dexes. They get hacked. So if you don't want governments involved, then you're going to have to accept that this is riskier from a number of angles.
That's true. Yeah, exactly. I'm curious, coming back to another part of like a bit of FUD that's hit the markets recently, the past few months. I recently did a podcast with Charles Edwards from Capriol Investments. I don't know if you know him, if you've spoken to him, but he has a theory that the real softness in Bitcoin wasn't 1010, but quantum risk. Now, I don't personally necessarily believe that, but the quantum risk is something that's now been talked about a lot. And I don't know if it's something you've looked into or done any research on, but do you think this quantum computing and the risk of encryption being cracked is really a concern, especially how quickly AI is evolving? I'm curious, if something you've looked into or thought about.
So let's say today China has a quantum computer. What do they do with that? Where's the highest prize? Is it to hack Bitcoin and everybody sees immediately that there's been a quantum hack of Bitcoin and Bitcoin goes to zero? None of the money, they won't make any money from it because the prices would fall immediately. Where's the biggest prize? Well, it's the US defense system, the European defense system, Google, Facebook. The entire system is based on that SHA-256 encryption. We're going to have to change all of these things. So if quantum was the risk, then Google's share price will be falling. The US government would be in blind panic. So I don't believe that to be the case. But do we take it seriously? We need to. Ethereum's moving that way, Sui's moving that way, I'm sure Solana are, and finally the Bitcoin devs are starting to wake up and realize that you're going to have to do something. But Bitcoin is always slow to move, takes a lot of debate. But, we don't want to lose all the old tokens because it's not the new wallets that matter, it's the old ones where you've got the quantum problem. So I think game theory would suggest crypto's the last place that they'd start because there's not going to be some guy in his garage. It has to be a nation state, really, or a giant tech company to have a quantum computer that's able to do this. And where would they put it first? Because if not, you make the announcement to the world, we've got quantum computing. And you would attack Bitcoin first? No, you'd attack all of the defense, all of the everything else, and then you might try and scoop a bit of Bitcoin if you can before it goes to zero.
I think the theory is, look, in terms of the quantum cracking, for example, a lot of the banking encryption, military encryption, it's easily upgradable, RSA, and it's actually easier to crack a ECC or electric curb cryptography than RSA on these things. And then the question is, okay, well, upgrading banking systems and all the protocols they require in terms of other encryption is easier than having to coordinate a decentralized network like Bitcoin, where you've got so many different.
I don't think so. I think a network is more adaptive than the financial system. The financial system is fragmented, complicated, out of date. To try and coordinate every bank of every major country to entirely change the encryption systems, I think is near impossible. Well, it's not impossible, but it just takes a lot longer than really getting a bunch of people. We're seeing with Ethereum now, they're now starting to work on the quantum proofing. It'll be a much faster process than the banks could do. The banks would be years to do this. It took them long enough with Y2K, and that was much less of a risk. That's
fair, yeah. Going back to one more piece of another concern potentially for this year for Bitcoin specifically is the DAT risk. I think that there's quite a few people that are worried about, look, are they going to continue selling if they can potentially become a forced seller? Saylor's been buying ridiculous amounts of Bitcoin with strategy, and it still hasn't really moved the needle that much. So I'm curious in terms of, and also the fact that I think last year was the first time that sailors actually started stacking fiat to meet the preferreds, pay for the preferreds. Do you think that debt risk is an issue, and how do you think the debt market plays out over the next few months?
I think the debt market is probably cheap if you think crypto's going up. I think we've passed the first round of risks. We saw some people selling out of tokens, buying back their shares. I think in a full bear market, we might see more, but I also think we will see kind of corporate raiders buying the DATs, stripping the assets, if they're trading at a discount. I'm less worried than I was about the DATs overall. I think Michael Saylor's cleaned up his balance sheet as well by raising the fiat to take that risk off, using the new share structure that he's built. I think that helps. Many of these will just wither on the vine. They just won't do anything. And they'll trade at discounts to NAV until the discount's big enough to break up the company. That's kind of how it feels like to me. And we've seen these with closed-end funds. Other ones, like Tom Lee is doing, and others are actually trying to build value. He's got the VC part of his and public market investing part of his portfolio. That gives some convexity to the upside. So it's not just looking like an ETF that trades at a premium and you take some cash out and stick it into the underlying. I think we'll see more of that. I think we'll see more operating company DATs that are trying to be ecosystem building the ecosystem out. So whether it's Solana, whether it's Sui, whether it's Avalanche, whether any of these ones that've got DATs, we could probably see them having VC, providing liquidity for lending, doing all things to grow the ecosystem, and that will grow the NAV per share.